Hello, beautiful people. Welcome to another brand new episode of the ITU forex class. In this week's edition, we're actually going to be talking about regular divergences. Okay, so if you've been a fan of the class, if you've been a regular, you must have heard me talk about MACD divergences or oscillator divergences in general. Okay, because they are one of the leading techniques that pro traders use to identify trending market conditions and when to get into the market with trading positions in the direction of the trend or when to anticipate reversals. Okay, so without any wasting any more of your precious time, let's dive right into it. Okay, so first things first, what is divergence? When the term divergence is referred to in trading, because as a word, obviously, is when two things diverge, right? But in trading, it also kind of has the same meanings, but you need to put it in context. Okay, so let me quickly show you, illustrate with a point, with kind of a drawing, so that you'll understand what we're talking about. Okay, so when we talk about divergence in trading, we're talking about when price and an indicator that ideally that are supposed to do the same thing are diverging from each other. So when you have an oscillator, like I told you in one of the classes that we've done in the past, is any technical indicator that oscillates between 2 points. Okay, so for example, you could have something like the MACD, or to make it easy for you to understand, let's use something like the RSI, which is the relative strength index. Okay, so in the RSI's window, which looks something like this here, you would have the reading on the lowest point of that window being 0, and then the reading at the top would be 100. Okay, and so when the RSI line goes all the way down, okay, to below a certain point, which in this case, the more conventional level that is used for that is known as the 30 level. Okay, so let's say this is the 30 level on your charts window for the RSI indicator, and this dotted line, okay, I'm trying to make it as dotted as I can. Let's say this is the 70 line here. Okay, the 70 line here. Now, most of the times, the way traders usually use the RSI indicator is when it goes below this 30 line. Okay, this is considered to be price, or the indicator, or whatever financial instrument you're analyzing. This is considered to be that particular instrument is oversold because it's gone down below the 30 line. Okay, and then when, let's say, the RSI line goes up and up and up and up and eventually crosses above the 70 line, okay, this dotted line in the RSI indicators window, this is telling us that whatever instrument you're analyzing with that RSI indicator is overbought. Okay, now the problem is the words that are used to describe these things in trading, like with the RSI, when you say overbought and oversold, when beginners who are just getting started into trading, when they hear things like this, they assume that because an indicator is showing us that price is overbought or price is oversold, that price is not going to move anymore in that direction, or because it's overbought, it can't go any higher, or because it's oversold, it can't go any lower. And that's not the way it works. Okay, because when the market is trending, and let's say, for example, that trend is a very, very strong trend, it is not uncommon for you to see price doing something like this, making highs and higher lows and higher highs and higher lows. Obviously, if for whatever reason, let's say when the indicator, the RSI indicator, was above 70, which is telling us that it's overbought, and then price made this higher low or higher high or whatever, price is not bothered that the indicator is telling people or whatever it is that it is overbought. It's going to keep forming higher highs and higher lows and breaking above resistance and continue moving in the direction of whatever trend it is, even if that RSI indicator is going to, reach almost 100. It could stay above here for, depending on the time frame that you're trading, for days or even weeks on end. When the RSI is telling you that, okay, this particular instrument that you're analyzing is overbought, but then the instrument just keeps going up, it just keeps going up and up. So the thing is, professional traders don't use this RSI indicator or any other oscillator for that matter with the sole purpose of saying, okay, when it goes above here, price is overbought, I'm just going to sell. Or when it goes below here, price is oversold, I'm just going to buy. you could use this method to trade. Obviously, with trading, everything is a numbers game, because if you use this technique, which if the RSI, for example, goes above 100, like with anything in trading, it's not that black and white. There are shades of gray, okay? So if price goes above this level, if you're putting this together with proper risk management and you've backtested it and you've proven that it works over time, okay, you could use this as your edge in the market. But what I'm saying is, the way inexperienced traders or newbie traders blindly follow this indicator is not the way it is used. Okay, and all of this is to lay way for how we are going to be using it today, which is, in my humble opinion, the better way of using the RSI indicator and other oscillators. And how exactly are we using it in this version? Well, ideally, when price is doing one thing on the chart, the RSI or any other oscillator is supposed to mimic what price is doing. So if price, for example, forms a higher high, the RSI should also form a higher high. If price forms a higher low, the RSI, ideally, in a normal market setting, the RSI should also form a higher low. Now, when price forms a higher high, but then the RSI fails to form a higher high, but then it forms a higher low. Okay, price is doing one thing and the RSI indicator is doing the opposite. That is what is referred to as divergence, because price and the indicator are diverging from each other. Okay, price is going up and the indicator is going down, so they are not agreeing with each other. And in a nutshell, what that is simply telling you is that the indicator is telling you that whatever move you're analyzing on the price chart, the momentum, because that's what the RSI basically measures in the market, okay? So the momentum behind that move is not as strong as it used to be. And so there's no much push or there's no much force behind that particular move. And when that occurs, there's a likelihood that price is either going to temporarily stall or completely retrace or reverse altogether. Okay? So when we are using divergences to trade, we are actually studying when price is doing one thing and the RSI or the other oscillators, whichever one you choose to use, is doing a completely opposite thing, which is telling us that the move that we are seeing in the market right now doesn't have very strong momentum behind it or doesn't have strong follow through behind it. So at any moment we are expecting kind of like a reversal in the market, and so we'll take advantage of that reversal. Okay, so now that we have the doodles out of the way, let's go back to the chart so that you can see exactly what we're talking about in a way that's going to make sense for you to understand, okay? So let's quickly add one oscillator onto the chart so that we could use it to analyze this thing we've just talked about. So as you can see, when I click on the Insert tab on the navigator menu inside the MetaTrader platform, navbar, sorry, you can see that we have indicators as a category. Then you have oscillators. Now, any one of this you could use. Some people use the stochastics oscillator for gauging divergence, and some people use MACD. I preferably like to use the relative strength index. That's just my preference here, okay? And for this particular purpose, we don't need to use the 50 line. So I'm just going to leave the settings as is, and I'm just going to click OK to add it to my chart, okay? Now, here's what I was telling you earlier on. You see, in an ideal world, in an ideal setting, when price forms a low, you want the RSI or whatever oscillator you're using to also form a low, which is what we had here. But then price pulled back. Remember, for this particular moment, it looked like price was in a downtrending market because price was forming a low and a lower high. And look what the RSI did. It also formed a lower high. And then all of a sudden, price formed a lower low because this low is actually lower than this previous low. So we're forming the anatomy of a downtrending market here. Price is forming low, lower high, lower low. Okay, so ideally, if this downtrend was supposed to continue, we would have had the formation of a lower high, but that never happened. But that's just one piece of the thing that I want to draw your attention to, because when you look at the RSI charts here, you'd notice that even though price formed this low, which is lower than this low, so this is technically a lower low, the RSI actually formed a low which is higher than its previous low. So price is doing one thing and the RSI is doing a completely different thing. So we have divergence here in the market. And this is what you want to look for in the market. Because this move that you saw on the charts, even though price formed a low that is lower than this low, it's telling us that this particular divergence that we're seeing on the RSI on the chart is telling us that the momentum or the volume behind this down move is actually not that strong. And so there's a very high likelihood that price is going to reverse from forming this downtrending market structure to maybe temporarily reverse into the upside. And that's exactly what happened. So assuming you saw this divergence, price from this low, RSI from this low, price from this low, which is lower than this one, RSI formed a low that is actually technically higher. Then let's say you saw this divergence, and at the close of this bullish engulfing candlestick, you decided to take a long trading position with a stop loss below this area, because if for whatever reason after you take this trading position, price was to come all the way down here, then it's likely that price is going to continue forming lower lows and lower highs, and so you don't want to be, your setup would have been invalidated. You don't want to be in the trade by that time. And so let's say you took this trade setup. Okay, assuming you took this trade setup, I think, let me pick the crosshair here. The distance between this area, this your entry, and this, what would have been your stop loss for this particular currency pair, the Euro USD here, it would have been around, let's just say 18 pips, but let's just round it off to 20. So if you're going for a 1:2 or 1:3 risk to reward ratio trading position, price would have hit your profit target somewhere around here. Or if you're going for a 1:3, price would have hit somewhere around here. This would have been a good profitable trade for you. Now, does this mean that every single trade you spot with the divergence setup is going to be a winning trade? Of course not. And that's part of the reason why we're using this risk to reward ratio and keeping our risk consistent. We're using it to our advantage, because for the times when we are wrong, assuming you're just risking a portion of your trading account's capital on each trade you take, you're only going to lose, a tiny fraction of your account's capital. But then when you hit a profitable trading position, then you're going to make multiples of that. So that even if you were to end up losing more trades than you win, eventually you would end up being more profitable at the end of the day, okay? So let's quickly take a look at some other examples here, okay? So what other example do we have here? Here you could see clearly, this is also another divergence example that we have. So for whatever reason, price was forming the market structure of an uptrending market. So it was forming higher highs, higher lows, higher highs, and higher lows, and obviously a higher high. But at this moment in time, you would notice that price had started struggling to continue forming higher lows. And it was kind of testing its previous lows, okay? And then it was just barely breaking above resistance and kind of forming like fake outs. And then this was, just a switch in market structure or the character. Now, when you pay close attention to what we had on the RSI indicator here, you notice that, remember, the oscillators are supposed to mimic what price is doing. So when price forms a higher high, technically speaking, the oscillator should also form a higher high. And when price forms a higher low, again, the oscillator is expected to form a higher low. But when that doesn't happen, and so price does one thing and the oscillator does a completely different thing, that is divergence between price and the oscillator, which is a warning signal that the trend that is predominant in the market does not have, the same push that it had in the market. And so there's a likelihood that price is going to reverse and start moving to the other side of the trend, okay? So in this case, this was our high, and then the RSI from this high, okay? And then we had a high which was just barely above this high, but it was still above it. It was still higher than this previous high. But look what the RSI did. It was clear that this particular high on the RSI was lower than this previous high. And on the price charts, this high is actually higher than the previous high and all the previous two highs. But then this high on the RSI, it was just almost barely the same height with the previous high. And then the previous high before that was even higher than this. So we clearly have a divergence in the market here. Okay, so now that we have this divergence, after the formation of this indecision candlestick and then the formation of this bearish engulfing, you could have taken a short trade setup here after spotting this divergence. And then let's say your stop loss was above this high, which is totally valid, because if for whatever reason, after you take this short trading position here, price decides to go all the way up here to hit your stop loss, then this trade setup would have been invalidated, because for whatever reason, price might decide to continue forming higher highs and higher lows. And so the trend is technically still in the markets, but that never happened. And so if this was your trade setup, okay, this would have been your entry, your stop loss. And if you were risking, let's say 1:2, remember the reason why we are risking small, let's say we are risking, for example, 20 pips and aiming for a profit of 2 times that 20 that we are risking, or 3 times that 20, is because even if we were to lose more trades than we win, eventually, because our profits on average are much larger than our losses, those profits that we would make would not only pay for the losses that we would have incurred, but they will give us extra profits in the process. Okay, so that's why we want to keep trading with a positive risk to reward ratio, meaning we're risking a small portion of our account capital on each trade we take, and then we're always trying to make multiples of what we're risking, so that eventually we're going to end up being profitable. That's our edge, part of our edge, that is. Now, in this case, you could see that if we had entered the trade somewhere around here, and our stop loss was just above this high, we would have been risking something like 40 pips on this particular trade setup. Now, if you were trading with the 1:2 risk to reward ratio, this would have been 80 pips, your profit target, that is. And price would have easily hit your profit target somewhere around here. And if you are even aiming for a 1:3 risk to reward ratio, so you would have been risking that 40 pips and aiming for, let's say, 120 pips. So you would have gotten short here with your stop loss around here. And if you're aiming for a 1:3, again, price would have easily hit your profit target somewhere around here. So in a nutshell, regular divergence, which is what we're talking about today, is the signal that is going to alert you, okay, because price is doing one thing and the indicator, the oscillator that is in this case, is doing the complete opposite. That is a warning signal that it's telling you that the momentum behind the trending move in the market is not very strong, and so there's likely going to be a switch in the direction of the trend, and so you want to take advantage of that switch. It's a counter trend trading strategy. Okay, regular divergence is a counter trend trading strategy. When you identify regular divergences in the market, the idea is that it's alerting you that whatever direction the trend was, whether it was a bullish trend or a bearish trend, the strength behind that move, as soon as you spot a divergence on the charts, it's telling you that the momentum behind that move is weakening. And so there's a likelihood that price is going to reverse and start moving to the other side. Okay? So, moving on. Let's see if we could get another currency pair that we could just analyze. Anyone here. Let's use something like the GBP JPY. Let's use something like the 4-hour time frame, because we've just done the 1 hour. Okay? So, again, look at this clearly here. It would appear as if I'm cherry picking these setups, but truly I'm not. And even if I was, I want you to understand something. No matter how many winning trades I'm showing you, I'm not telling you that the method or the strategy that we are learning here is going to give you winning trades 100% of the time. In fact, quite the contrary. I try to make it that you're always aware, that you're always prepared, that whenever you take a trade using a trading strategy or a trading methodology you learn here, you should always be of the opinion that you might end up losing more trades than you win, which is going to just make it very, very important for you to practice proper risk management. Because without practicing proper risk management, if you win 50% of the time and lose 50% of the time, then at best, you're only going to be at break even. But at worst, assuming you're not even doing proper risk management, and let's say when you lose a trade, you start revenge trading and you risk more, trying to make back your profits and all of those things, you might even end up losing a huge chunk of your trading account's capital. So it's not about winning all the time. In fact, the trading strategies that I use to trade on my personal accounts, more often than not, most of them have a winning rate that is below 50%. But because they're structured in such a way that, and thank God, obviously, but they're structured in such a way that my profits are 2 or 3 times what I'm risking on average, then I still manage to end up being profitable after taking a large number of trades. Okay, so for this particular example, notice what we have here. Price has been in an uptrend for this particular chart, okay, for this particular instrument. So why did I say that price has been in an uptrend? Well, if you look at the charts closely, you notice that from the inception of this low, price made a high, and then it pulled back to form a higher low. Why? Because this low compared to this low is actually higher. And so eventually price now broke above this resistance, okay, and then it formed a high that is higher than this previous high. And so it pulled back. it continued doing this over and over and over again. Okay. Now, when you look at the RSI, you notice that this particular movement in price action has been mimicked just the way we want it to be. Okay. So I'm going to draw your attention to all the way up here. Now, look what the RSI did all the way up here. You can see that it was even in the overbought territory, but it doesn't really matter because obviously we're not using the overbought or oversold trading technique. We're just using the RSI to spot divergences in the market. Okay. Now, when price was at this peak, you can see that the RSI was somewhere around here. But then what I want to draw your attention to is the fact that eventually price made a pullback. But then when it formed another high, that high was actually higher than the previous high that we had here. So when you compare this high to this previous high, price was actually forming higher highs. But what was the RSI doing? This high, as you can see, when you compare it to this previous high, it's actually divergent to the downside. So here, obviously, we had the formation of a divergence. Okay, so assuming after you identified this divergence on the RSI and price action, and you saw the formation of this indecision candlestick, let's say you got good timing and you entered into this trade with a short trading position and your stop loss was somewhere around here. Okay, in this case, if I pick the crosshair tool here, you notice that your entry, the distance between your trade entry and your stop loss would have been, because this is the GBP JPY currency pair, so it's a very volatile pair, around 90 pips. Let's just round it up to, let's say, 100 pips. Now, if this was your trade setup and you're aiming for a 1:2 or 1:3 risk to reward ratio, meaning if you're risking 100 pips, you're aiming to make 200 or 300 pips in profits, you can see that this trade would have easily hit your 300 pips profit target somewhere around here. Okay, so this is not it's not rocket science, guys. You just identify when price does one thing and the RSI is doing a completely opposite thing, and then couple it with a little bit of candlestick analysis and just take your trade setup with proper risk management and aim for a positive risk to reward ratio, and you're good to go. Eventually, if you keep trading like this with proper discipline, keeping your risk consistent and always taking those trade setups regardless of the sequence or the outcome of the past couple of trades that you took, eventually your edge is going to play out and you're going to end up being profitable. Okay, so it's really that simple and that hard, actually. So this pretty much brings us to the end of this week's edition of the class. But again, before we wrap up, I would like to use this opportunity to invite you guys, one as usual, to test out our suite of bots, which are the ITU suites of bots. We've got the ITU Goldmine, the ITU SBT, ABT, and BBT, which are designed to look for low risk, high probability trading opportunities on your behalf, scan the markets for those setups, and then place those setups for you with proper risk management when you follow our risk recommendations. So if you're interested, please reach out to us on any of our social handles or drop a comment in the comment section, and we'll be more than happy to assist you, walk you through how you set everything up step by step and start earning while you're learning how to trade. Okay, so you diversify a portion of your portfolio to automated trading and start reaping the advantages of this $1 trillion market. Okay, so again, if you're interested, please feel free to reach out to us and we'll be more than happy to assist you set everything up. I sincerely appreciate you guys taking time out of your busy schedules to attend these classes. I look forward to seeing you guys in next week's edition of the class. Have a wonderful rest of your week and cheers. God bless you all.